Inventory is a big one. We mentioned in previous episodes that cash sitting on your shelf, if you will. And if you have obviously inventory that isn't moving, it's sitting there and it's elongating or making that cash conversion cycle longer. And then receivables is the other one. Shorten your days to collect payment, or like we did, remove it entirely as part of the revenue cycle of the business. And those are some of the tactics you can use. But on the inventory side, definitely have a better approach to optimizing your inventory. Welcome to Those Odd Numbers podcast. My name is Jason Snider. I'm the founder and CEO of Main Street Financial Group. We are your fractional finance team.
I'm Summer McFarlen. I'm a CPA and certified tax coach. I'm also the co-owner of Main Street Tax Group, where we do strategic tax planning so you can keep more of what you earn.
I am Masheka Turner, and I am the owner of Bright Skies Business Services. We are your outsourced accounting firm and profit first strategies. And we are here to help you create wealth through your business by gaining clarity around your numbers.
Hello again, everybody. Welcome to another episode of Those Odd Numbers. I'm here again today with Masheka Turner and Summer McFarlen, and I'm Jason Snider, the owner of Main Street Financial. Today, we've got a topic that may not have been heard about by many of our listeners, but I think very relevant, especially for our inventory-heavy business owners, and that's cash conversion cycle. Like I said, it's not as common term used in turnaround or other distress situations. This is a very important metric, especially if there's secured lenders or other lenders involved in the turnaround process and things. But for our day-to-day business owners, this also has very high relevance. Again, if you're heavy inventory, you're going to be wanting to pay attention to what we're going to talk about today. And so basically the cash conversion cycle is for when you put out a dollar for when do you get it back is what we're trying to measure. And obviously the shorter amount of days, the less you have to fund. And then I guess you'd say less liquidity that you need to hold on your balance sheet as well. And basically the formula is days outstanding payables, inventory sitting on your shelf, number of days, and then receivables days. And the shorter those days, the better for the business and things. And like I said, it's heavily impacting our inventory businesses because especially those who have requirements from their suppliers of 30% down. If they're ordering from overseas, that's basically usually the cycle of 30% down, the rest of it when they ship. And obviously you're paying in advance, you haven't received it, you can't sell it. It's not available in the warehouse. And if you're an Amazon seller, it's not even available as in stock, which limits your capability to be able to sell. And so you have a long chain, if you will, of cash disbursements before you ever receive a dollar of revenue and things. And so it's pretty important metric to look at. And I know we were talking earlier before we started to hit the record button of what some other industries that would be affected by or would definitely want to be knowledgeable about the cash conversion cycle and the impact on their business and things. Maybe we should start with some of the ones that aren't affected by this, which is why they often don't have financing issues compared to some other firms and things. Masheka, you have I think you had
I think one of the businesses, we talked about it off camera, that's probably not affected the most is subscription-based businesses, because essentially they're getting paid usually in advance. And they don't have to deal with receivables because they are getting their money in advance. Usually professional services are not as affected. Usually attorneys come to mind. Usually they get a lot of their money up front.
With that retainer, and then you have to replenish the retainer as it's used. Yeah. I think the accounting industry as well, except I have run into some that have accounts receivable, but anymore now, I know our monthly recurring clients, we ACH their monthly fee on the first of the month. We don't even work with them on if they want it the 15th we do it on the first of the month. And then on my tax clients, I don't file their return until their invoice is paid and their invoice is locked down to their e-file signature authorization. So they have to pay it before they can sign anything. So that's how I have alleviated a lot of that stress from trying to collect. Yeah.
And it brings up a good point of adjusting your business model, especially early on if you're at the beginning stages of the business. But even midpoint of adjusting it. It's something that I was mindful of as started Summit and now Main Street doing something similar, that we're not in the business of collecting money. We're in the business of providing advisory services, bookkeeping, accounting services, and chasing money isn't something that I want to fund the expense side. And also it impacts service levels for working with our clients. And so we went the route from the beginning that we would do, I think the term in the industry is fixed fee arrangements, a set amount for the services that we deliver. And we collect it at a set date every month. And you need to retain a payment method that's active on. Otherwise, we will stop services, I think, after 30 days, if I remember correctly. And we designed that intentionally from the beginning to lessen the administrative burden and better focus on our client needs rather than waiting for payment every single time to get them to follow up. In some cases, like Summer mentioned, they can be several weeks to a couple of months, and we're just not in a place where I want to be able to have to fund months of salary for our team while we're waiting for our clients to make payments and things. So it's really facilitated a better quality relationship with our clients as well, because we're able to deliver services consistently on time and not have to worry about, hey, did we get payment? Oh, can we start again because they made another payment? There are a few situations where we'll take on, but it's full visibility on our part of understanding what the risk is. But understanding the cash conversion cycle can lead to modifications in your business model as well to improve that. So it lessens the burden. And obviously, as a professional services firm, we don't have inventory, but I'm paying my team twice a month, whether or not the client has paid us. And I obviously can't lose them. Otherwise, I can't continue maintaining services. So that's understanding that cash conversion cycle can lead to adjustments in how you manage and plan your business, especially if you're at the early stages of it.
Yeah, for professional services, I think the labor cost is probably our highest expenditure.
Yeah, which makes sense why attorneys want to collect a retainer in advance.
And sometimes we do too, if we don't know what we're getting into, if we can't tell during discovery.
It's why we do for one-time projects. If it's more than, I think, $500, we collect 2% of it upfront to get started, with the remainder being done once everybody's satisfied that we've completed the work to what the contract specifies, the work scope specifies. So you can do things to manage that for your business, even if it's not industry standard per se, but you need to find a way to communicate it to your counterparties that it's of value to make that change. But understanding the cash conversion cycle and being intentional, you can make adjustments to improve that and make it more favorable or less burdensome depending on the situation.
Yeah, I was just thinking, I live in the Huntsville, Alabama area, right? So there's a lot of defense and space around here. So a lot of businesses that revolve around government. I don't know. I feel like lately, everybody I've talked to, times are pretty good right now, right? But government stops spending, then people have to get laid off. And I was talking to someone because they got laid off for a little while during COVID. I was like, what did you do? And she goes, this is my 5th or 6th layoff. I just have money set aside. She had learned, she had been through it enough with being her career for many years that it was going to happen and she was just going to have to prepare for it. So if she wanted to stay working in this industry.
Some tactics that business owners can apply to shorten that time days of cash conversion. One is increase terms. Now, I'm not a big fan of this one, particularly unless you're in a distressed situation. I think building goodwill with your vendor, especially if you can make it visible as a relationship with your suppliers, to keep it, even pay it a few days in advance. But it is a tactic, especially if it's a more distressed or a one-time situation, that you can go to your vendors. Hey, we have this situation. We're going to pay, but we're going to break it into 2 things because I need to smooth out some lumpy cash needs that are coming up. That is one of the pieces of the formula to work on. If the situation, inventory is a big one. Now, the thing there that I see the most is obsolete or inventory that's not being converted. So we mentioned in previous episodes that the cash is basically cash sitting on your shelf, if you will. And if you have obsolete inventory that isn't moving, it's sitting there and it's elongating or making that cash conversion cycle longer. And then receivables is the other one. Shorten your days to collect payment, or like we did, remove it entirely as part of the revenue cycle of the
Yeah.
business. And those are some of the tactics you can use. But on the inventory side, definitely have a better approach to optimizing your inventory, because I see it sinks. I don't want to say it sinks the business, but it definitely causes more distress around cash than any other thing where there's not a better process to manage the inventory. And then more importantly, move it on if that particular item or thing isn't selling, liquidate, take it off your balance sheet and bring that cash. It's not just a profitability question at that point. It's getting it off your balance sheet, converting it to cash, and then taking that and putting it to some other inventory that is going to sell.
Yeah. And I could see where that specific example that you just gave, that's probably such a dance for e-commerce specifically.
Yeah.
Just because it's not that easy just to switch things up.
Yeah.
Because you've already spent the money on the goods that you have. So I can see where it's just something that's constantly need to be reviewed and not getting ahead of yourself by buying too much.
Yep. Yeah. And it's maybe a little bit of a side note, but there's a lot of the revenue opportunities for dollar stores. I guess they're not really dollar stores these days with inflation, but the $2.25 store now, a lot of their inventory actually comes from old, obsolete inventory. Not all of it. It's not, but there's an ecosystem out there that where larger retailers, e-commerce retailers will go to get rid of their inventory and they'll often relabel it so it doesn't affect if they have a brand that they're trying to protect as well to keep it out there. But that's a interesting side note of there are other places that you can put that inventory, take it off your hands, if you will. Especially the Amazon, you've got limited capacity where it'll allow you to store at their warehouses and things. It just there's so much that goes into on the e-commerce side. But so there's these small, less visible ecosystems that are out there to help you take those things off your plate and move it on so you can get some cash at least for it.
That makes sense as a frequent visitor of the $2 store. Good grief, where did this come from?
And when I see those, wait, who thought this was a good idea to try to sell?
Somebody did.
Somebody did, yeah.
At the dollar store.
Yeah. People make a lot of money off of what used to be 99-cent stores. Fortunes have been made from that.
Yeah.
And that brings to mind, maybe that's why there still can be in some cases dollar stores, because they're probably buying it for pennies on the dollar and stuff just to get it off. But
just to get it off their shelf, right? Quit paying those Amazon storage fees and things.
Yeah. Real estate isn't cheap. It's a lot of money take to support square footage. And if you can reduce that, it makes sense. It's not a direct profitability question at that point. It's more of a, hey, what's my overhead? All these other costs. Let's just get it off and move it towards some other profitable part of the business.
Yep.
Any other things you can think of for industries that this might be applicable? I think we could definitely beat the inventory e-commerce side of it.
Yeah. Construction, because you're dependent on draws, you're dependent on weather, you're dependent on a lot of things. Medical, I would say medical too, and dental. You're dependent on a lot of times on insurance if you're not a private pay only, right?
Insurance payments are definitely a big one that aren't visible as well. So it's a lot of things. And again, circling back to what we always talk about is you need good bookkeeping and accounting in place to be able to measure this. If you don't, you're blind leading the blind a little bit. If you're using bad data to come up with this, because you could make some pretty poor decisions if you don't have that full visibility. This would be one you definitely need to have very almost squeaky clean books to be able to put this together. But it's a very powerful number to understand, given what I just said. Modifications of business model, revenue models, cost structures can all be influenced. If you understand that number and how it impacts your business, it can unlock a lot of capabilities as well.
I agree. And that's the thing. There's just no way to get around it. We have to have cash to operate. And like Jason said, of course, I've said this before, nobody wants bookkeeping, but it is a part of the process. It's a part of the process. And for that clarity, you have to have good, solid, up-to-date books.
Yep.
I think that's a good note to leave it on, to reinforce our favorite term, the bookkeeping matters.
Bookkeeping is the foundation.
Thank you both. And thank you everyone for listening to another episode of Those Odd Numbers. We look forward to seeing you on a future episode.
Yep. See you later.
Thank you.
This content is for general informational purposes only and is based on current law and guidance as of the date of recording. Tax law and regulations are subject to change. This discussion should not be considered tax, legal, or investment advice. Listeners should consult their own tax or financial professional regarding their specific situation.